Okay, so we want to talk to you guys about interest rates, right? So say that you're buying a car and they tell you that there's a 4 or 5% interest rate. Like that can be confusing. So explain to us what the interest rates are.
So an interest rate is simply put, as I know how, is the fee that you're paying for borrowing that
Right.
money.
Okay.
Nothing's free, and it's a risk for these places to give you money um, to front for the purchase of a vehicle or a house or whatever it may be. So that's your fee to them.
Right. So
For
if a car cost $1,000 and you gave them $1,000,
yeah, no interest, it's yours.
right, you're
You know,
just, but if you're going to borrow that money from them,
you're going to pay
then
a fee for
then you're going to pay a fee to borrow it.
it.
Okay, and that's what the interest rate does.
Yep.
Okay, that makes good sense. So, of course, interest rates some are high, some are low. Like, how do you what? So the higher the lower, what's that mean?
So your interest rate will depend a lot on what your credit rating is. Um, and it depending on what it is, houses 20 years ago had high interest rates, up in the tens, sometimes low teens. Now they're like 2 or 3%. Cars can be very vast. It can be 1.9%. Some of them have 60 months no interest. If you meet a certain credit, a certain credit level, and all the way up to 10 to 12% for cars if your credit's bad. So they can fluctuate a lot. A good way to find if you're getting something, hey, am I getting a good deal? Is this a good credit rating? Um, Shop. I mean, there are if you're going to buy a house or if you're looking at getting an apartment, and there's some sort of an interest fee that's going in with that. Shop a couple different places. Ask some people around. Hey, if you've got a friend, if you're buying a car, they just bought a car. What was yours? Now, just on its face, if they tell you one that's lower, that doesn't mean you're getting a bad deal. Their credit score could be a little bit better.
Right.
So and it's without diving into much of your friend's personal
Yeah.
information, but it's a good starting point. Again, shopping rates, that's more with real estate, and homes and things of the sort. But yeah, you can a quick Google search. There are consumer reports out there that will break it down by your age. You can find how much interest is the average 17-year-old being charged on a car this price. It'll
Gotcha.
tell you that specifically.
I remember I learned interest rates through getting a credit card.
Mm-hmm.
Right. It was 1 year, no interest.
Yeah.
Right. So you were only paying back what you borrowed.
Mm-hmm.
And then as soon as that 1 year's up, it goes to,
25%.
yeah, it goes to 25%.
Yeah.
Like, and I was just shocked. And of course, that's kind of the deal. So,
Sure.
Obviously the higher the rate, the more money you're paying. So you
Yeah.
really want to fight for that low
Mm-hmm.
payment. You want to shop. I know another, like, car lots, usually when I go to buy a car, I'll usually check a credit union
Mm-hmm.
to see if their rates are a little bit better than the car lots. And a
Yeah.
lot of times they can
A
be.
lot of times they will be.
So yeah, so you just have to kind of, like you said, you just have to kind of
Shop it
shop
around.
around a little bit. And I know that we had talked earlier. So if your credit score, the higher your credit score, you're going to get the best rate,
Yeah.
right? So the lower your credit score, they look at it like you're a little more risky,
Yeah, so
right?
you're going to pay a little bit higher of a fee
Right.
to borrow that
To
money
borrow that money.
because in their eyes, whether your intentions are, oh no, I'm going to make every payment, they don't really care. They're like,
Right, because
you're riskier to us.
right, because if you're low credit score, you've either missed payments on something or you're new into
Yeah.
loaning money. So they look at that risky, so you're automatically going to get a higher
Mm-hmm.
a higher interest rate. Yeah, that makes sense. So are interest rates? Can you find? I mean, are they the same with the car, with the house? Like, can you expect to pay the same thing on everything?
Not no. A lot of things are different. Again, talking about a house, you're borrowing a lot of money most of the time, unless you're a millionaire, you just got the money.
Right.
Most of the time, you're borrowing a large sum of money. That's why the payback times are so long, and that goes into also different lengths of mortgage times. You'll see a lot of shorter mortgages have a much smaller interest rate because it's not as much of a long term risk for these people. You know, there's this thing called time value of money, and the easiest way to understand that is $1 today is always worth more than $1 tomorrow. That value of the dollar over time will always be a little bit less. Um, and other factors can speed that up or slow that down. But so, like a 30-year mortgage, for example, is going to have a higher interest rate because in 30 years, the money that you borrowed isn't going to be nearly as much, not worth as
Right.
much to these people. Um, But yeah, so a house, again, like I said earlier, 20 years ago, house interest rates were pretty high, and then now they're pretty low. And cars can range a lot. They can
Gotcha.
go from basically nothing to up in the low teens, and so it all really just depends. A lot of these places, when you go to like if you're going to buy a piece of furniture, or if you're doing some sort of an in-house financing at a location, a lot of them will do an introductory period, like a credit card. That'll be 24 months, 0% financing, and what that means is you are just paying back what you borrowed.
Gotcha.
No additional interest. But be careful. If you let any of the payments go past that, they're going to backdate all of your interest.
Oh, wow.
Yeah.
So you got to be very,
You
yeah.
got to make sure it's if they give you 24 months, 0% financing, make sure it's paid off in 24 months. Or you will pay that high interest for the whole period.
Which is probably just a good disclaimer to
Yeah.
read the small print,
Yeah,
right?
Definitely ask them about that.
Yeah.
Hey, if I go past this 24, this 36-month introductory period, am I going to have to pay back interest? And they'll always be like, well, yeah.
Yeah.
And it's like, well,
So it's probably safe to assume anytime you're getting 0%, there should be somewhat of a red flag, right?
Yeah.
On
And a lot of times, like I know a lot of places when we bought our house, we financed a lot of our furniture, and it was like 0% for like 60 months, and more than enough time to pay that off. But beyond that, okay, now I'm going to get 5 years of interest back charged on me, and double the amount of what it
Wow.
was that we bought it for, and that's another thing. I mean, depending on what your interest rate is, it's going to vastly increase what it is that you're actually paying back for the money that you borrowed. If you are getting student loans and you've got $25,000 in student loans, and your interest rate on those is 5%, okay, you're not paying back $25,000. At the end of that, whenever you do finally make your last payment, you've probably paid off closer to 40.
right.
And that's a lot of people will see that, on their mortgage or on their student loan statements. It's like, well, my payback amount is so much more than what I borrowed. That's the catch. That's your fee for not having the money up front.
Gotcha. So do the interest rates always stay fixed? Like once you get that loan, does it move?
So it really depends on what type of loan you get. In a perfect world, yes, it would be fixed. That's what you want.
Right.
You want to know that it's going to be fixed. But a fixed rate is very risky for the company loaning you the money, because the value of the dollar might be great in 5 years. It might not be. And then they're either making a lot of money off of you, or they're losing a lot of money.
Right. It's kind of more of a gamble for them.
So as far as like student loans go, there are subsidized loans, there are direct Stafford loans, and I can't remember which of the two is which, but one of them is fixed. The interest is what it is. The other one is like, well, okay, it's gonna change depending on what the economy's doing.
Right.
Um,
Probably anything that's a long term.
Long term, they'll offer it both ways.
Right.
They always will. For anybody out there that's going to buy a house, don't take the gamble on like an ARM.
Right. Or
adjustable
you're the
rate
balloon
mortgage.
payment, right?
Yeah.
Which is where you pay very low for so long, and then
Yeah, you're kind of banking that you're going to be making a lot more money in 10 years.
Yeah.
You might not be.
Yeah. So a fixed interest rate is definitely something
what
that
you
you want to ask if you're not sure.
If at all possible, that's what you want.
Are most car loans fixed?
Yes.
Yeah.
Yeah.
That's been my experience.
There are very
Most of those
rare
are fixed.
cases if you go through some sort of external financing agency, like if you had your own credit union, like you mentioned, they may do a variable. But I used to work in the car industry for a short period of time. If you are getting a loan from a car loan distributor, it's going to be fixed.
Fixed, yeah. Okay. All right. I think that wraps that up.
Awesome.
All right. If you guys have any other questions on this page where you found this video, there's an inquiry tab where you can put in your name and information, and we'll get back with you. And if you guys want to meet, if you have any more questions about interest rates, quick phone call, come by and sit down with us. Just let us know. We'd love to help you out. All right. Thanks.
Yep.